Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about a stock that was suggested by a subscriber. That stock is Johnson & Johnson. Johnson & Johnson is engaged in research and development, manufacture and sale of a wide range of products in the medical field. Today we will be reviewing the company's 10K annual report to get a better idea of its business segments. Then we'll review the company's fundamentals by focusing on its key ratios. We'll perform a discounted free cash flow DCF analysis to find the intrinsic value of the company, and finally do an expected rate of return calculation to see if you were to invest in Johnson & Johnson at the current stock price, what kind of return can we expect on this investment? So let's dive in and review Johnson & Johnson.
Hey guys, let's start off by looking at the Form 10K, which is the annual report that Johnson & Johnson filed with the SEC. This is for the fiscal year that ended January 3rd, 2021. And on page 7 of the report, the company provides a business overview. Johnson & Johnson states that it is organized in 3 business segments. First is its consumer health segment, second is its pharmaceutical segment, and the third is its medical devices segment. The consumer health segment includes a broad range of products focused on personal health care used in skin, beauty, over-the-counter medicines, baby care, oral care, women's health, and wound care markets. The company then outlines some of its major brands such as Aveeno, Clear & Clear, Neutrogena, Tylenol, Listerine, and Band-Aid. The second business segment is its pharmaceutical segment, which is focused on 6 therapeutic areas. First is immunology, second is infectious disease, third is neuroscience, fourth is oncology, fifth is cardiovascular and metabolism, and sixth is its pulmonary hypertension. The company outlines that medicines in this segment are distributed directly to retailers, wholesalers, hospitals, and healthcare professionals for prescription use. The third and last operating segment is its medical devices segment. The medical devices segment includes a broad range of products used in interventional solutions, orthopedics, surgery, and vision fields. Next, on page 81 of the report, Johnson & Johnson provides a revenue breakdown across its business segments. The company provides a table which shows the sales to customers in the year 2018, 2019, and 2020. The company also provides a percent change in the year 2020 versus 2019 and 2019 versus 2018. Under the consumer healthcare segment, the over-the-counter section for the worldwide market saw an 8.5% increase in the year 2020. The healthcare and beauty segment saw a decline all across the board, which makes sense because people were not using any skincare products. Next is the oral care. We can see that the company saw a 7.4% increase in the worldwide market. Next is the baby care. Even though there was an increase in revenue in the United States, the worldwide segment overall saw a 9.4% decline in sales. After that is the women's health. The worldwide segment saw an 8.6% decline in the year 2020 when compared to 2019. And finally, the wound care and others, which saw a 7.2% increase in the year 2020 when compared to 2019. So for the holistic total consumer health segment, we can see that there was a 9% increase in sales in the United States for the year 2020 when compared to 2019. However, overall, worldwide, we only saw a 1.1% increase in revenue, which was because we saw a 4.6% decline in sales in the international market. The next operating segment is its pharmaceutical segment. For the immunology section, we can see that there was a 5.5% increase in sales in the United States, a 13.2% increase in sales in the international market, and overall we saw a 7.9% increase worldwide. For the infectious disease section, we saw 8.6% increase in sales in the United States for the year 2020, a 1.3% increase in sales in the international market, and a 7.4% overall increase for the worldwide market. For the neuroscience section, we saw a 5.9% increase in sales in the year 2020 in the United States. For the international market, it saw a 1.4% increase in sales, and overall we saw a 3.5% increase in sales for the year 2020 when compared to 2019. After that, looking at the oncology section, we saw an 18.5% increase in sales in the year 2020 in the United States, a 13.8% increase in sales in the international market, and overall we saw a 15.7% increase in sales worldwide. After that, looking at the pulmonary hypertension segment, we saw a 26.6% increase in sales in the United States, an 8.2% increase in sales in the international market, and overall we saw a 20% increase in sales worldwide. Finally, looking at the cardiovascular, metabolism, and other section, in the United States we saw a 6% decline in sales in the year 2020, a 6.1% decline in sales in the international market, and overall we saw a 6% decline in sales worldwide. So for the overall pharmaceutical segment, in the United States, we saw a 7.8% increase in sales in the year 2020, an 8.3% increase in sales in the international market, and overall worldwide we saw 8% increase in sales in its pharmaceutical segment. Finally, looking at the third and last operating segment, which is Johnson & Johnson's medical devices segment, the sales in this operating segment has been decreasing over the years, which is evident when we look at all these negative percent changes over the years. For the total medical devices segment, we saw a 10.9% decline in sales in the year 2020, a 12.2% decline in sales in the international market, and worldwide we saw 11.6% decline in sales in the year 2020. When we add up the sales from all three operating segments, we can see that in the United States, Johnson & Johnson saw a 2.5% increase in sales, a 1.3% decline in sales internationally, and worldwide it saw a 0.6% increase in sales. Finally, when we look at the income before taxes numbers, we can see that the pharmaceutical segment brought in the majority of the company's money, as about $15 billion out of the $17 billion in income before taxes came from the company's pharmaceutical segment. Now that we have a good idea of Johnson & Johnson's business and its key operating segments, let's review the company's fundamentals by focusing on its key ratios. Hey guys, now let's look at the key ratios for Johnson & Johnson. I'm on Morningstar looking at Johnson & Johnson. Under key ratios, we have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company made from sales. Back in 2011, Johnson & Johnson's revenue was about $65 billion. And for the year 2020, it was about $83 billion. Over the past 10 years, the company's revenue has been increasing. Next, looking at the operating income. The operating income is what we get when we subtract cost of goods and operating expenses from the company's revenue. Back in 2011, Johnson & Johnson's operating income was about $16 billion. And for the year 2020, it's about $20 billion. Over the past few years, the company's operating income has stayed fairly consistent. Next, looking at the operating margin. The operating margin is the ratio of the company's operating income to its revenue. Back in 2011, the company's operating margin was about 25%. And for the year 2020, it's about 24%. When we look at the past 10-year trend, we can see that Johnson & Johnson's operating margin has stayed consistent over the past 10 years, and ideally we want the company's operating margin to be staying steady or increasing. Finally, looking at the net income. The net income is the bottom line of the income statement. This is the amount of money that's left with the company once it has paid for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2011, the company's net income was about $9.7 billion. And for the year 2020, it's about $15 billion. Over the past 10 years, the company's net income has been positive. There was one unique year back in 2017 when we reported a $1.3 billion net income, which was significantly lower than its preceding years. This is because in the year 2017, the Tax Cuts and Jobs Act got enacted, which led to the company having to pay higher taxes, which led to a lower net income number. However, over the past few years, the company's net income has stayed consistent. Next, looking at the dividends per share. Back in 2011, Johnson & Johnson paid out $2.25 per share as dividend, and for the trailing 12 months, it paid out about $4.04 per share as dividend. When we look at the past 10-year trend, we can see that Johnson & Johnson has been hiking its dividend every year for the past 10 years. Next, looking at the payout ratio. The payout ratio is the comparison of the company's dividend per share to its earnings per share. So this number gives an idea of how much of the company's income is actually being paid out to the shareholders in the form of dividend. Back in 2011, the company's payout ratio was about 54.1%, and for the year 2020, it was about 61.6%. What this means is 61.6% of the company's income for the year 2020 was paid out to its shareholders in the form of dividends. Ideally, we want the company's payout ratio to be staying steady. However, in the case of Johnson & Johnson, the payout ratio has been increasing. This is primarily because even though the company has been hiking its dividends, the company's earnings per share has not been increasing alongside with that. Next, looking at the shares outstanding. Back in 2011, Johnson & Johnson had 2,775 million shares outstanding, and for the trailing 12 months, it has 2,671 million shares outstanding. When we look at the past 10-year trend, we can see that from 2011 through 2013, the company was issuing more shares, as the share count had been increasing back then, and ever since 2013, the company has been buying back its shares as the share count has now dropped off. It dropped off to about 2,670 million shares in the year 2020. Over the past 12 months, the company issued more shares because the share count has now increased by 1 million shares. Ideally, we want the company's shares outstanding number over the years to be decreasing, as that means that the company has been buying back its shares, and this process of buybacks actually helps increase the existing shareholders' ownership within the company. Next, looking at the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. Back in 2011, Johnson & Johnson's book value was about $22.53 per share, and for the trailing 12 months, it's about $25 per share. Over the past 10 years, the company's book value has stayed steady and positive, and a positive book value tells us that the company always had more assets than liabilities on its balance sheet. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract capital spending from the company's operating cash flow. Back in 2011, Johnson & Johnson's free cash flow was about $11.4 billion, and for the year 2020, it was about $20.2 billion. I will be using the past 10 years of free cash flows for my expected rate of return calculation, and I will be using the 2020 figure of $20.189 billion for my discounted free cash flow DCF analysis. When we look at the past 10-year trend, we can see that the company's free cash flow has been increasing every year for the past 10 years, and this is definitely something we want to see in a company. We want to be investing in companies that have a positive and growing free cash flow. Now let's look at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line, so it compares the company's net income to its revenue. Back in 2011, the company's net margin was about 14.87%, and for the year 2020, it's about 17.82%. What this means is every $100 that Johnson & Johnson made in the year 2020, by the time it paid for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had $17.82 left as pure profit. Ideally, we want the company's net margin to be staying steady and positive, and that is what we are seeing in the case of Johnson & Johnson. Next, looking at the return on equity. The return on equity is a ratio of the company's income to its shareholders' equity. Warren Buffett prefers to only invest in securities who have a return on equity of 8% or greater every year for the past 10 years. Back in 2011, Johnson & Johnson's return on equity was about 17.02%, and for the year 2020, it's about 23.97%. Over the past 10 years, the company's return on equity has always been greater than 8%. Except for that one unique year back in 2017 when the Tax Cuts and Jobs Act got enacted, which led to the company reporting a lower income number, which meant the company reported a lower return on equity number. A return on equity that's greater than 15% indicates that the company has a moat. In other words, Johnson & Johnson has a competitive advantage as its return on equity numbers have been greater than 15%. Next, looking at the return on invested capital. This number gives us an idea of how good the management is at allocating the company's capital and getting a return on that investment. Back in 2011, the company's return on invested capital was about 13.39%, and for the trailing 12 months, it's about 16.22%. Johnson & Johnson's weighted average cost of capital, also known as the company's hurdle rate, is about 5.6%, and since the company's return on invested capital is much greater than the company's hurdle rate, we can safely say that management is creating value for its shareholders. Finally, looking at the interest coverage. The interest coverage is a ratio of the company's income to its interest obligations, so it gives an idea of how many times can the company pay off its interest obligations using its income in that calendar year. Back in 2011, the company's interest coverage was about 22.64 times, and for the trailing 12 months, it's about 73.87 times. Benjamin Graham, the father of value investing, preferred to only invest in securities who had an interest coverage of 5 times or higher. Now let's look at the financial health of the company, focusing on the liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want the company's current ratio to be greater than 1.5. However, at the bare minimum, we at least want the company's current ratio to be greater than 1.0. Back in 2011, the company's current ratio was at 2.38. For the latest quarter, it's at 1.28. Every year for the past 10 years, the company's current ratio has been greater than 1.0. Next, looking at the quick ratio. The quick ratio is similar to the current ratio except we disregard the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. A quick ratio greater than 1.0 tells us that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2011, the company's quick ratio was at 1.88, and for the latest quarter, it's at 0.97. Next, looking at the financial leverage. The financial leverage is the ratio of the company's total assets to its shareholders' equity. A high financial leverage ratio tells us that more of the company's assets are fulfilled via liabilities. Back in 2011, the company's financial leverage was at 1.99, and for the latest quarter, it's at 2.63. The company's financial leverage has slowly been increasing over the past few years. Next, looking at the debt to equity ratio. This ratio compares the company's total debt to its shareholders' equity. Ideally, we want the company's debt to equity ratio to be less than 0.5. Back in 2011, the company's debt to equity was at 0.23. And for the latest quarter, it's at 0.46. Johnson & Johnson's financial health and liquidity ratios are better than its competitor Merck. However, they're comparable to its competitor Pfizer. Now let's look at the efficiency ratios for Johnson & Johnson. The first item on the list is the day sales outstanding. This number gives an idea of how many days go by from the day Johnson & Johnson recognizes a sale to the day it actually receives cash for that service rendered. Back in 2011, it took Johnson & Johnson about 57 days to receive cash. And for the year 2020, it took about 62 days for the company to receive cash. Over the past few years, the company's days sales outstanding number has stayed consistent. Ideally, we want the company's days sales outstanding number to be staying steady or decreasing. An increasing days sales outstanding number tells us that the company is being aggressive with its accounting. In other words, it is being aggressive by recognizing its sales sooner so that it can show better numbers on its income statement. Next, looking at the days inventory. This number gives an idea of how many days does Johnson & Johnson take to sell its inventory. Back in 2011, it took Johnson & Johnson about 104 days to sell its inventory, and for the year 2020, it took about 118 days to sell its inventory. Over the past few years, the company's days inventory has stayed consistent. Next, looking at the payables period. This number gives an idea of how many days does Johnson & Johnson take to pay its suppliers. Back in 2011, it took Johnson & Johnson about 101 days to pay its suppliers, and for the year 2020, it took about 115 days to pay its suppliers. We do see an increase in the payables period for the year 2020 when compared to the year 2019. An increased payables period tells us that the company may be trying to hold on to its cash in order to artificially inflate its cash flow numbers. However, that payables period number has dropped off for the trailing 12 months. Finally, looking at the inventory turnover, this number gives us an idea of how many times does Johnson & Johnson's inventory go through its system in a calendar year. Back in 2011, Johnson & Johnson went through its inventory about 3.5 times, and for the year 2020, it went through its inventory about 3.1 times. Over the past 10 years, the company went through its inventory on average about 3 times in a calendar year. Now let's compare the company's current valuation to that of the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. Johnson & Johnson's PE is at 30.1, whereas S&P 500 is at 27.6. Johnson & Johnson's price to book is at 6.8, whereas S&P 500 is at 4.3. Johnson & Johnson's price to sales is at 5.4, whereas S&P 500 is at 3.1. Johnson & Johnson's price to cash flow is at 18.8, whereas S&P 500 is at 17.4. And finally, the dividend yield. Johnson & Johnson has a dividend yield of 2.4%, whereas S&P 500 has a yield of 1.5%. On all the valuation metrics other than the dividend yield, we can see that Johnson & Johnson is overvalued when compared to the S&P 500. Hey guys, now let's look at the discounted free cash flow DCF analysis for Johnson & Johnson. Over here, I pasted Johnson & Johnson's 2020 free cash flow number that I got from Morningstar, which is at $20,189 million. I'm using an annual growth rate of free cash flow to be 5%. What this means is I expect Johnson & Johnson's free cash flow to grow at 5% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I want this investment to give me a 10% return. I'm using a long-term growth rate of 4%. What this means is after the 10-year mark into perpetuity, I expect Johnson & Johnson's free cash flow to grow at 4%. Johnson & Johnson has 2,671 million shares outstanding and has a long-term debt of $32,635 million. After taking all of these inputs into account, we get the intrinsic value to be about $125 per share. When we compare that to the current stock price of about $169 per share, we can see that the current stock is trading about 35% above the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about $158 billion. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We sum all those up to get the intrinsic value to be about $367 billion. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about $125. Now, if you disregard the perpetuity component, in other words, if you think that Johnson & Johnson will only grow for the next 10 years and then it'll cease to exist, then we get the intrinsic value without the perpetuity to be about $46 per share. And if you disregard both the debt and the perpetuity, then we get the intrinsic value without the debt and perpetuity to be about $59 per share. Finally, since we know that the company's weighted average cost of capital, also known as the company's hurdle rate, is about 5.6%, and if we add a 3% margin of safety on top of that and make our discount rate to be about 8.6%, then we get our intrinsic value to be about $169 per share. And when we compare that to the current stock price, we can see that the current stock is neither under nor overvalued. Hey guys, now let's look at Johnson & Johnson's expected rate of return calculation. Over here, I pasted the past 10 years of free cash flows that I got from Morningstar. This is the yearly free cash flow trend that we get over the years. All the numbers here are in millions of US dollars, and we can see that the free cash flow has been trending upwards. Next, looking at the future data and predictions, I'm assuming that there's a 35% likelihood that Johnson & Johnson's free cash flow will grow at 7%. There's a 50% likelihood that its free cash flow will grow at 5%, and a 15% likelihood that its free cash flow will grow at 3%. These are the potential free cash flow rates that we get into the future. After taking into account the numbers of shares outstanding, which is 2,671 million shares, at the current stock price of about $169 per share, we can expect to get an annual return of about 4.9% on this investment. What this means is, if you were to purchase a share of Johnson & Johnson at the current stock price of about $169 per share and hold the security through 2060, then we can expect to get an annual return of about 4.9% on this investment. Hey guys, now let's wrap it all up. Review Johnson & Johnson's 10K annual report to get a better idea of the company's business. We saw that Johnson & Johnson has 3 operating segments. The first is its consumer health segment, second is its pharmaceutical segment, and third is its medical health segment. We saw that pharmaceutical segment brought in majority of the company's sales. Johnson & Johnson's revenue, operating income, as well as net income over the past 10 years have stayed fairly stable. The company has been hiking its dividend every year for the past 10 years, and the shares outstanding numbers have slowly been decreasing. Both of these indicate that the company's management is shareholder friendly. We saw that Johnson & Johnson's return on equity has been greater than 8% every year for the past 10 years. In fact, the company's return on equity has been greater than 15%, which tells us that Johnson & Johnson has a moat. In other words, the company has a competitive advantage. Next, when we looked at the company's return on invested capital, we saw that it was greater than the company's weighted average cost of capital, which tells us that the management is creating value for its shareholders. Additionally, we saw that the company's interest coverage is greater than 5 times, which tells us that the company can easily meet its interest obligations. Next, we looked at the company's current ratio, quick ratio, financial leverage, and debt to equity ratio. All of those ratios are comparable to its competitor Pfizer. In fact, they're better than the competitor Merck. Next, we saw that the company's efficiency has been maintained over the past 10 years. After that, we compared the company's current valuation to that of the S&P 500 and found that on all the valuation metrics, other than the dividend yield, Johnson & Johnson is overvalued when compared to the S&P 500. Next, we looked at Johnson & Johnson's discounted free cash flow DCF analysis and found that when we use a 10% discount rate, the intrinsic value came to about $125 per share. And when we use the 8.6% discount rate, the intrinsic value was about $169 per share. So with an 8.6% discount rate, the current stock price is neither under nor overvalued. After that, we looked at the company's expected rate of return calculation and saw that if we were to invest in Johnson & Johnson at the current stock price of about $169 per share, we can expect to get an annual return of about 4.9% on this investment. In conclusion, Johnson & Johnson is a fundamentally strong company. It is a good business with a moat. However, at the current stock price, the company is neither under nor overvalued. In other words, the company appears to lack a margin of safety. And if we think about the opportunity cost, our capital would be better allocated in an investment outside of Johnson & Johnson. Hey guys, that is all I had for you this week. Hopefully you found this video on Johnson & Johnson interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions as to which stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.